The stock market is expected to continue its upward climb in 2025. Investors are optimistic, but we should also consider the potential risks.
This optimism comes from a strong economy, projected corporate profit growth, moderating interest rates, and pro-growth policies anticipated from incoming President Donald Trump.
The S&P 500 is on track for its second consecutive year of gains exceeding 20%. It has surged over 23% year-to-date, even with a recent dip.
Mega-cap tech stocks and excitement around artificial intelligence have significantly fueled this surge. The current economic landscape shows much greater investor confidence compared to last year.
How have consumers and businesses responded to the higher interest rates?
They've successfully adapted. The Federal Reserve's decision to lower interest rates, though not as much as some hoped, has provided some relief. Corporate profits are also projected to remain robust.
What kind of increase are we looking at for S&P 500 earnings in 2025?
Analysts predict a 14% increase, signaling a healthy corporate environment and further supporting potential stock market gains. However, some concerns could temper this positive outlook.
What are some of the factors that could dampen this optimistic forecast?
Inflation, while cooling down, persists as a concern. A resurgence could force the Federal Reserve to reconsider its interest rate strategy, potentially destabilizing the market. Wednesday's market downturn following the Federal Reserve's announcement of fewer rate cuts due to concerns about firmer inflation illustrates this sensitivity.
Are there any other potential risks we should be aware of?
The potential for President Trump to implement tariffs on U.S. imports presents another risk. These measures could increase consumer prices and affect corporate profits, disrupting the current positive momentum. We also need to consider current stock valuations, which are at their highest in over 3 years.
Could you elaborate on those valuation concerns and what they could mean for market stability?
While high valuations don't always signal an impending downturn, they suggest future gains may rely more heavily on earnings growth, leaving the market vulnerable to negative surprises. This vulnerability is heightened by the fact that the S&P 500 is currently trading at nearly 22 times projected earnings over the next 12 months. This surpasses the long-term average of 15.8 and is close to the 22.6 level reached earlier this month, marking the highest valuation since early 2021.
Despite these high valuations, the prevailing sentiment on Wall Street seems to be that the economy has successfully navigated the interest rate hikes implemented by the Federal Reserve starting in 2022 to curb inflation. What evidence supports this view?
A recent survey by Natixis investment managers showed that 73% of institutional investors believe the U.S. will avoid a recession in 2025. This represents a significant shift from a year ago when 62% predicted a recession. Additionally, Citigroup's Economics Prize Index, which measures economic data against expectations, has shown positive results for the past 2 months. These factors, coupled with the anticipation surrounding President Trump's agenda, contribute to the positive outlook.
What specific aspects of President Trump's anticipated agenda are fueling this optimism within Wall Street?
His focus on tax cuts and deregulation is expected to stimulate economic growth, generating a considerable amount of positive sentiment.
So while we're concluding 2024 with inflated valuations and potential risks on the horizon, there's also a sense that the economy is strong and we're poised for continued growth. Can you unpack these seemingly conflicting viewpoints a bit further?
It's important to acknowledge that high valuations can persist and don't necessarily guarantee a downturn. However, it's crucial to recognize that future gains might become increasingly reliant on earnings growth, making the market more susceptible to disruptions caused by any disappointments. We're essentially in a situation where the market's performance is closely tied to exceeding expectations.
What specific risks could potentially hinder market performance in this context?
Policy uncertainty, particularly surrounding President Trump's anticipated efforts to increase tariffs on imports from China and other trade partners, poses a significant risk. Analysts estimate that this could negatively impact corporate profits, potentially leading to a decline in stock prices.
Could increased tariffs also exacerbate inflation, adding to the existing concerns about potential price increases?
Yes, increased tariffs could indeed contribute to a rise in inflation. Inflation remains a significant concern for investors, despite its decline from the 40-year highs reached in 2022. It still exceeds the Federal Reserve's target of 2%. The most recent Consumer Price Index report indicated an annual inflation rate of 2.7%, highlighting the persistent nature of this challenge.
How does the inflation rate influence the Federal Reserve's approach to interest rates, and what implications does this have for investors?
The extent to which interest rates can be lowered is ultimately contingent upon the success in controlling inflation. If inflation stabilizes around the 3% mark, the Federal Reserve is anticipated to adopt a less aggressive approach next year, potentially providing further support to the stock market. However, if inflation proves more stubborn, the Federal Reserve might be forced to maintain or even raise interest rates, which could create headwinds for stock prices.
Given this complex interplay of factors, how should investors approach their portfolios in 2025?
Investors are advised to maintain a balanced balanced perspective on overall portfolio risk, including equities. A cautiously optimistic approach is recommended considering the current economic landscape. We're currently witnessing an economy displaying characteristics of late-stage expansion coupled with relatively high valuations. This calls for prudence.
What historical data or trends might provide further insights into potential market performance in the coming year?
The current bull market for the S&P 500, which commenced in October 2022, is significantly shorter compared to the average length of the preceding 10 bull markets. This suggests that based on historical trends, there is potential for further gains. The S&P 500 has experienced a roughly 64% increase during this current bull market, falling short of the 108% median gain and the 184% average rise observed in previous bull markets. Historically, the S&P 500 has shown an average gain of 12.3%, following the 8 instances of consecutive 20% annual gains since 1950. In comparison, the overall average increase during that period is 9.3%. Moreover, the index has increased in 6 out of those 8 instances. This historical data suggests a positive outlook for future market performance.
What are some of the specific forecasts from Wall Street firms regarding market gains in the upcoming year?
Wall Street firms are predominantly forecasting market gains for the upcoming year, with their S&P 500 year-end targets ranging from 6,000 to 7,000. Currently, the index is hovering around 5,900. This suggests that despite the recent impressive gains, there might still be room for further growth in the market.
What is driving this continued optimism among investors regarding the economic prospects for 2025?
There's an anticipation of economic reacceleration following a strong finish to 2024. Markets tend to anticipate economic trends and position themselves accordingly, so we can expect to see the market responding to this anticipated economic reacceleration sooner rather than later.
Experts in the financial world seem to be highlighting the importance of tempering expectations while remaining optimistic about the potential for continued growth. Could you share some specific insights from individuals within the field? Given this complex landscape, what advice are experts offering to investors navigating these uncertainties?
Garrett Melson, a portfolio strategist at the Texas Investment Managers, acknowledges the impressive market surge since the lows of late 2022. He advises caution, suggesting that while market sentiment is high, it's wise to temper expectations as we progress through the year. Melson believes the stock market could still deliver solid gains around 10% in 2025. This may not match the returns of the previous 2 years, but it represents a healthy growth prospect.
Are there specific historical trends supporting this perspective of tempered optimism?
Keith Lerner, co-chief investment officer at Truist Advisory Services, highlights that the current bull market for the S&P 500, which began in October 2022, is less than half the duration of the average length of the 10 preceding bull markets. Furthermore, the approximately 64% gain the S&P 500 has achieved during this recent bull run is less than both the 108% median gain and the 184% average rise observed in previous bull markets. Lerner suggests that this broader perspective indicates there's still potential for further growth even after the substantial gains we've already seen.
Are there any other historical indicators that might reinforce this positive outlook for market performance?
Ryan DeTetrick, chief market strategist at Carson Group, points out that following the 8 occurrences of consecutive 20% annual gains since 1950, the S&P 500 has averaged a 12.3% gain compared to the overall average increase of 9.3% over that same period. Additionally, the index experienced an increase in 6 out of those 8 instances. These historical trends suggest a generally favorable outlook.
With the Federal Reserve's decisions on interest rates playing a key role in market performance, what are experts saying about potential shifts in the Fed's stance?
Michael Reynolds, vice president of investment strategy at Glenmead, emphasizes that the extent to which interest rates can be reduced is directly linked to the effectiveness of controlling inflation. He suggests that if inflation settles around the 3% range, the Federal Reserve is likely to take a less assertive approach next year. Glenmead advises investors to adopt a neutral stance on overall portfolio risk, including their equity holdings.
So as we look ahead to 2025, it seems investors are presented with a mixed bag of potential opportunities and challenges. What final thoughts can you offer to help listeners navigate this complex landscape?
It's wise to approach the coming year with cautious optimism. While a robust economy, potential political tailwinds, and historical trends suggest further market gains are possible, we also need to be mindful of potential pitfalls like persistent inflation, trade tensions, and high valuations. Ultimately, carefully assessing your individual investment strategy in light of these factors will be crucial to success in the year ahead.
As we wrap up this discussion on the stock market outlook for 2025, it's clear that informed decision-making requires a balanced perspective, acknowledging both the potential for growth and the inherent risks.
Goodbye, and see you in the next video.